what we all know about Bett is she got recently graduated in IT, and she has been working at Verizon as an IT architect, and she is a president of our Toastmasters Club. But what we all don't know about Bett is she is an obsessive amateur economist in the spare time. She has done a lot of research on economics, and she is going to give some important tips about the economic crisis. I welcome Bett to give a speech.
Okay, so I need to fix my props. Okay. Last week, the FDIC closed 7 banks. This makes 52 banks that have been closed this year. Only 25 banks closed last year. Yesterday, the Dow Jones closed at 8,616. In 2007, on October the 9th, the Dow Jones closed at 14,164. That is a 61% drop. Unemployment has just now come out in the last few days, 9.5%. This is a 26-year high. I'm 30 years old. Since I was 4, this is the highest unemployment we've had. If you lived in California, you might be getting your paychecks as IOUs. How would you like that? So what happened, right? Why are we in this state? Well, we had a bubble. We had a great big bubble. And today I'm going to explain to you where do bubbles come from. There's 2 special criteria that have to happen for a bubble to be created. Number 1 is there has to be new economic assumptions. And number 2, you have to have new exciting technologies. Okay, so number 1, what are these new exciting assumptions? Number 1, the circularity of money. So when we spend money in the United States, that money flows overseas because we're usually buying goods and services from other countries like China and Asia and Latin America, and all that money flows overseas. And the idea here is that because the global economy is circular, all that money will come back to the United States eventually. Okay, so the money goes around the whole world, everything will balance out eventually. The second principle, or the second assumption that was made during this bubble was that deflation is worse than inflation. Now this is the ideology that's behind the fiscal policy lately, meaning that the Ben Bernanke and Alan Greenspan kept the interest rates really, really, really low because they wanted to keep deflation away. With cheap money, the housing market boomed. Everybody who could make houses built them, people wanted them, everyone who could buy a house did. In fact, we got to 69% of the population in the United States owning their own home by 2006. Okay? So because money was very cheap, everyone could get a house, and the whole economy was booming there. But at 69%, all these people still couldn't get houses. That's because they didn't have jobs, they couldn't afford a down payment, or maybe they just had really terrible credit. Well, don't worry, we have ways of fixing that. We invented new types of loans. Adjustable, actually these existed before, but they became very popular. Also, we reduced the criteria so that anybody could get a loan. It doesn't matter, you don't have to even show you have a job. 500,000? No problem, let's just give you that. Okay, so adjustable rate mortgages mean the interest rate's going to go up and up. And negative amortization also means that every month you owe more and more. You're not paying off anything. Okay, so now we come to our third new economic assumption, which is that spending is noble. When you go out and spend, you're stimulating the economy. You're doing a noble deed. After 9/11, President Bush told us, go spend your money. Well, we were spending all this money buying foreign goods and services. That money was traveling overseas. Well, what are they going to do with the money? Well, they're going to invest it back in the United States. They first of all used to buy treasury bonds. But treasury bonds have very low interest, and they want to have higher interest. So a new invention came up, which brings us, before we actually go to the new exciting technologies, let's look at quickly at the U.S. household debt. The U.S. household debt went from 7 trillion, which a trillion I heard is as tall as the Empire State Building, I believe, dollars stacked on top of each other. 7 trillion in household debt to $13.8 trillion in 2006. Okay? Actually, let me tell you one other thing. When people, realize that spending is really a good thing for them to do, very important, because they were spending every penny that they made, they started going into their houses as piggy banks and taking that money out and spending that. And those are called HELOCs, home equity line of credit. Okay, so they're spending all this money. Now foreign people come over here, invest it. They want something that gives more interest. In 2000, David Lee, a Wall Street analyst, came up with a paper with a new sort of way of calculating risk. Because loans have all these different variables, it's very difficult to correlate all the variables. He came up with a new thing that said, what you need to do is look at the price of a group of assets today, and that should be a good price for tomorrow. So we're going to use past experience to determine future outcomes, which we all know is a very stupid thing to do. But every single person on Wall Street and the credit agencies who rate things all decided this was the greatest thing since sliced bread. So they started taking huge pools of loans, pulling them together, thousands and thousands of them, and they called them credit or CDOs, collateralized debt obligations. All the foreign countries started buying these up like they were going out of business. Another exciting new technology is the CDS, credit default swaps. Okay? Credit default swaps are insurance on a debt. If that company that you lent your money to goes out of business, don't worry, because AIG, who writes these credit default swaps, will cover that debt for you. So the entire globe is crisscrossed with all of these different CDOs, credit default swaps, until the entire economy and the globe is connected. Now, all those poor people who have these ARM loans, the interest rates goes up, they can't pay their mortgage back anymore, they go into foreclosure. That brings the whole housing market down. The entire bubble collapses, and guess what? The entire economy collapses, and we're in the mess that we are today. So, what do you guys take from this? Well, first of all, bubbles have been occurring all the time in the economic history. There was the tulip crisis of 1500s, and we had the dot-com bubble just a few years ago. All bubbles will have these two different criteria. So be aware of them, understand, where they come from. And right now, there's new bubbles being created, so please keep your eyes open.